Good morning, everyone. Thanks for joining us today for another Quantitax IC-DISC Services webinar. I'm sure you'll find today's presentation useful. We have a very timely and significant topic, great guest presenter who's definitely in a lot of demand, and we really appreciate his returning so soon. Many people tried to make our December sessions, but due to year-end planning obligations was tough. So we very much appreciate your returning by popular demand here, Mike. And also want to give a special thanks to Sachs Consulting and Investigative Services, our sponsor. For those who are not familiar with Sachs, and my friend Tim Dimoff, or if you only know Tim from local and national news and print media, Sachs is the largest ex-military and retired law enforcement security company in Ohio. They specialize in temporary and permanent higher levels of security and corporate personal investigations, HR services, corporate training, physical security analysis, active shooter specialists. They've been of use to many of our CPA and law firm alliance partners and their clients in these matters and many others. Just want to clarify before we get started, today's focus is going to be on we will be talking about clean energy credits, but it's going to be on the transferability of these clean energy credits, which can be between completely unrelated parties. So it's not as much focused about attaining the credits or investing in the credits, but rather the selling and buying between these parties that are completely not related and buyers that might have nothing to do with these clean energy incentives. So earlier in the year, those IRS guidance, or sorry, earlier last year now I should say, was guidance was released, and that's been one of the big factors that's caused such a boom in this transferability market. I've seen it in my client base for sure, particularly for credits with we'll call it a face value of between $500,000 and $10 million. So people with those kind of credits that are selling to others that have liabilities in that neighborhood over a period of years even, and looking to purchase those. So we have, as I mentioned, great presenter today, is uniquely qualified as a practitioner in this area. You may have seen his bio on the event page, but Mike Minihan is an attorney who also holds an LLM. He has worked at two Big Four consultancies, worked at the IRS counsel's office, co-founded a successful boutique international tax service firm, WTP Advisors, that was later merged into a top 10 practice, Ryan Consulting. He is now a managing partner at BX3 Capital. He's leading their clean energy incentive practice, and he's bringing significant value to the marketplace. And a lot of this value is by working through general CPA firms to bring these credit opportunities to their client base that might not otherwise be able to benefit. Mike is licensed to practice law in New York, DC, and Connecticut. He's very widely published. He's been a source for Wall Street Journal articles. He's testified to congressional panels on tax matters, yada, yada, yada. Very, very accomplished author and practitioner. So, Mike, thank you again for joining us today. And without further ado, we'll let you kick it off.
Thank you much, Amit, and happy to be here today. So thanks for having me. Yeah, so today we'll talk about transferable clean energy tax credits. We'll do a little bit of background. We'll talk about how we did it the old-fashioned way, what happened post the Inflation Reduction Act. We'll spend a brief moment on the types of transferable credits, go through a basic transaction process. We'll get into the code and the regs. The CP police require a little bit of that. We'll get into some details about the transactions, risks, and by risks, I mean what happens if I buy a credit and the credit's wrong, or what happens if we have a recapture event. We'll spend a few minutes on the state of the market and what's going to happen going forward as a result of the 2024 elections. So on the background side, I think, kind of the best way to think about the transferable tax credit is, I think, if you think about tax as one of those things that never, ever goes on sale, the transferable tax credit, in real shorthand, is a way to think about a mechanism to get a sale on your taxes, right? You have a situation where you have sellers of credits who've either, they own the qualifying property, they've participated in activities that have resulted in a credit that they either can't use now or can't use ever. And this is an opportunity for them to monetize it. So for $1 of tax credit, the market will say that $1 of tax credit can be sold at what the price the market will bear, and that price could be 95 cents or 90 cents or 85 cents, and in some cases it could be 75 cents. And we'll talk about how do you get to those prices and how do you get your sale price as we go forward.
Like having an In-N-Out burger gift card, but living in Cleveland, right? So
There
I
you
got it for
go.
$100, but um, yeah. So that's why I kind of think of an IRS gift card, if you will.
There you go. There you go. So one little addendum on my own background. So after my tax practice was merged into Ryan's, um, I had a choice of kind of staying on as a partner in Ryan or doing something different. I was kind of ready to do something different. So I started the BX3 capital business, and a lot of our early practice was around helping early stage companies. And as a result of that, most early stage companies, as you might guess, have a need for capital. And so, as part of that practice, we needed to establish a broker dealer relationship so we could actually help our clients compliantly raise capital. So, a couple of years in to doing that, the Ryan folks kind of reached out and said, "Hey, there may be a good opportunity for us to work together. We're working on a transaction where we need a broker dealer." And that transaction, as it turns out, was what's called a tax equity transaction. And this was the old-fashioned way of transferring tax credits. So we had the same situation where we had sellers who had credits that they couldn't use, or it certainly couldn't use currently. And this was a way to get other people, other taxpayers in the marketplace who could use the credits to be able to utilize that. And the way that we did that was through what basically looks like a partnership structure where the sponsor or clean energy project developer is contributing the project to the LLC, and you have a taxpayer who has a need for the tax benefits of that structure. They're contributing capital, and it's truly a financial transaction. So a couple of things that add complexity to this. The nature of the transaction is such that you're basically selling securities here, and that was the need for the broker dealer. The issues here was that super complicated, a lot of diligence was required. So these tended to be really high dollar deals. And they also, as a result, tended to have high dollar fees that were attached to them. So just to give you an idea of the scale of something like this, a recent transaction that we did on the tax equity side, the face value of the deal was about $70 million of tax credits. The fees attached to that were about $2 million. And that's not $2 million to us. The majority of those $2 million went to attorneys and advisors and energy consultants and people who were helping kind of structure that project. So one of our industry trade publications had a stat about the 2022 market, and that stat said that 80% of that market was covered by 10 tax equity investors. So you get a sense that this is a pretty closed market, right? Doesn't apply to very many people. So when the Inflation Reduction Act came along, it created a way to really open up this market, right? So you had much smaller developers who could directly transfer the credits to eligible taxpayers. This is a game changer, obviously, in terms of the way that the market opens up and in terms of the way that project developers are able to monetize these credits. Um, One of the things that I wanted to mention, particularly about the genesis of this transferability of tax credits post-Inflation Reduction Act, if you recall, prior to the enactment of the IRA, there was legislation that was getting kind of churned around through Washington, but didn't ultimately pass. That ultimately the final version was the IRA. But if you remember, the Build Back Better legislation was really the kind of the foundation of what became the IRA. In the original iterations of Build Back Better, in lieu of this transferable tax credit, what was in there was a refundable tax credit, where a sponsor would, develop a project. If they were eligible for a credit, they would file a return, even though they were showing a loss, and they would get a direct refund from the government. And I think one of the themes that we're going to see, and of course that didn't come into play, right? Except in certain circumstances, there is some refundability in IRA, but not for the most part. But one of the things that we're going to see as we go through this presentation today, one of the themes is that in lieu of this refundable credit, this transferable credit, which is where we landed, really shifts the burden of diligence and documentation. It shifts it back to the parties who are involved in the transaction, the seller and the buyer. And a lot of it goes to the buyer too, on the diligence side in particular. So that theme is going to come up over and over again as we go through the slides today. All right. Again, it's not a credit presentation per se. There's 11 credits that are transferable under the IRA, and we'll talk briefly about 3 of those, which are probably in our space, our sweet spot of this kind of $500,000 to $10 million of credits. I would say only 2 of those 3 actually are ones that we'll see on a regular basis. But we'll do a little bit just to give you some, kind of the lingo. So we'll start with production tax credits, Section 45. Production tax credit, you get a credit based on the amount of electricity that's produced from a qualified renewable resource. Those things are wind, could be solar, could be trash, could be hydro, any of those things. If you're looking for a headline credit amount under the production tax credit, that headline amount tends to land around 2.6 cents per kilowatt hour of electricity that's generated. The production tax credit is an annual tax credit. It's based on the amount of energy that's produced for a particular year. And there are bonus credits that are available. And the bonuses tend to be applicable if you, and I say you, I mean the sponsor developer, has met requirements around prevailing wage, apprenticeship, and those sorts of things, right? And that means that they've a certain number of hours in the project are filled by apprentices. They've met all of their kind of a wage baseline requirements and then some. Then there's a bonus credit that's available. It can go up to 10% of the production tax credit value. I put one item on here, this direct pay, this refundable. This is important if some of the folks who are attending, I know have our client service folks. If you have charitable clients or government entity clients, and by that I mean like state or county or municipal governments, some of those may be eligible for a refundable credit as a result of producing electricity from a renewable resource. So that's something to just keep in mind there. 45X, this is an interesting one. This is pretty new. So this made a lot of headlines. The 45X production tax credit is based on producing the components that produce alternative energy, right? So, and this applies specifically to things like advanced energy, battery storage, critical minerals, solar, winds, and those sorts of things. Section 48 investment tax credits. This is another one that we're going to see a lot in our space, right? Investment tax credits are really based on the upfront cost of purchasing or putting in place a qualifying energy project. The headline credit amount is generally 30% of the cost of the property. There are bonuses that may be available as well. No refundable option on investment tax credits. Okay. So Cliff Notes, investment tax credits versus production tax credits. Investment tax credits based on upfront expenditures. Eligibility turns on the property being placed in service and the cost of that property. Production tax credits, on the other hand, are based on annual energy production. You can't double dip. So if a particular piece of property was the subject of an investment tax credit, you can't then claim a production tax credit with respect to the energy that's produced from that property, or at least the same taxpayer can't claim that production tax credit. Because the production tax credits are an annual thing, you either produce the energy or you didn't. the production tax credits are deemed less risky than an investment tax credit. And as a result, the price per credit in the marketplace is generally a bit higher. Part of what we're going to cover today, basic transaction process. How do I get my sale price? Like, I want to get my taxes on sale. How do I do it? So this is really it, right? You've got a seller who's developing or operating a project, qualifies. They can't use the credit, want to monetize it. The seller goes through the process of pre-registering themselves and the credit with the IRS. We have the matching of the buyer and the seller. We negotiate a term sheet. We go to diligence. We produce legal documents around the purchase and sale of those credits. We have a closing, like the sale of any other asset. We have payment, of course, and then ongoing compliance. All right, so we've got some brand new purpose-built code sections and regs that deal specifically with the transferability of tax credits. Let's dig into the code and the regs a little bit. So on our purpose-built code sections, right? Who's eligible to transfer a credit? The answer is pretty much anybody, as long as you're a qualifying taxpayer who has qualifying property and you produce the energy or you purchase that qualifying property. Chances are you've got an eligible credit. And if you have an eligible credit, for the most part, you're able to transfer it. Where it doesn't apply is, for the most part, tax exempts can't transfer tax credits, municipal governments, Indian tribes, and those sorts of things. You can transfer the eligible credit itself as well as the bonus credits. You can fractionalize the credits, which is a really interesting concept, right? So if you're a seller who has 10, let's call it 10 of credits to sell, you could sell 6 to one taxpayer and 4 to another on completely different terms, and that would be okay. The one thing that you can't do is split the base credit and the bonus credit. Those have to go, if you have a project that's subject to bonus credits, those credits have to be spread pro rata amongst the transfers. All right, you can't resell a credit. So once a buyer has purchased a credit, they can't then go and sell it to somebody else if, for example, they get a better deal or someone makes them an offer they can't refuse. And once it's sold, it's sold. From a buyer eligibility perspective, what the buyers have to keep in mind is they need to be able to use the credits themselves, right? So that means taking into account the Section 38 limitations on the use of general business credits, whatever those limitations are, and also the 469 passive activity rules apply here. So because those 469 passive activity rules apply, what we see is that most of our buyers tend to be C Corps, makes it a lot easier. But you could also have a non-C Corp buyer who can use the credit to offset passive income. So we've got a couple of handy dandy charts here, right? Things to keep in mind is if you're a buyer of credits and you can't use them all currently, you can actually carry those credits forward or back or forward, right? Back 3, forward 22. So privately held C Corps, closely held C Corps, there's an exception in 469E2 that allows closely held C Corps as long as they're generating active income to use the credits as well. Here's another kind of handy dandy chart for individual taxpayers. If it's flowing through on either an SK1 or a partnership K1, a 1065 K1, as long as you are a partner with passive income, you can generally use those credits.
I think sorry, Mike, the last thing on this chart here is one that we've run into with you, which is cap gains, but that are passive. I mean, we have it marked on the chart as involvement passive, but I think that's really where the underlying business is, where your involvement in it is passive, like sale of apartment complexes or something that you're not actively involved in managing, right? That would be that profile there. Yeah,
absolutely. In fact, that would be someone who I think would want to enter the market and try and find credits in an unusual, like a year where they have a big hit of passive income. That could be a great year to go out and try and find some credits and get a discount on that tax liability.
Right. And then so someone who has ordinary earnings from a entity that they're involved in, they're getting a K1 with active income. That doesn't preclude them from using the credit on their 1040, but they would have to look to other income sources to apply it against, correct?
That's correct. Yes.
That are passive.
You got it. All right, so let's keep going here. So the seller, when do we have to do this? Seller has to make the election by the due date, the extended due date of its tax return. It has to be on an original or superseded return. Can't do it on an amended return. Can't get 9100 relief under unless it's like a really, really, really narrow set of circumstances to get 9100 relief here. So let's assume no 9100 relief, and you'll be safe there. Election to transfer credits, it's irrevocable. The seller also has a bunch of registration requirements that we're going to dive pretty deeply into because those are pretty complex. From the buyer's perspective, they have to incorporate the credit on its on the tax year that ends with or after the seller's tax year. So the important thing to keep in mind there is if you have a mismatch of tax years, right? You have a buyer with a fiscal year, a seller with a calendar year. The reason that mismatch is important is because of the timing of payment. So seller is going to want payment ASAP, and buyer will probably want to drag that out because their liability would otherwise have been vesting over the course of the quarters of its own fiscal year as opposed to the calendar year. So payments are payments for credits, not taxable to seller, not deductible for the buyer, has to be in cash, okay? Which means you can't do it for stock, for the buyer's own stock, can't do it for property. When does the payment have to occur? It's got to be the payment in full has to occur prior to the date, the earlier of the seller or the buyer filing their own tax returns. Okay, so you can have an installment contract, but the last payment on the installment contract has to happen prior to the filing of the earlier of the buyer or the seller's tax return for the year in which the credit is generated. All right, let's talk about seller compliance. First thing on this page and the last thing on this page, pre-filing registration, transfer election statements, those are really the meat of it. So we're gonna do those on separate slides. But on the compliance side for the seller, the items that go on the tax return are the things you typically would have included anyway, right? The source credit form. So for an investment tax credit, you need a 3468. A production tax credit, you need an 8835. That 7207 relates to those 45X advanced manufacturer of advanced energy tax credits. The seller has to include their credit registration number, which we're going to talk about later, as well as the 3800 showing that the credit was transferred and that registration number. All right, so this is the pre-filing registration. So here's where we want to spend a little bit of time. And here's where we're going to also come back to our original theme of shifting of the burden of the transaction, the diligence, the reporting, the documentation, shifting it back to the parties that are involved in the transaction. There's really two levels of registration that have to occur from the seller's perspective. They have to register themselves, and then they also have to register the credits. So the starting point is this IRS portal. You get yourself an energy credit online account. And once you have this energy credit online, clean energy account registration with the government, a lot of the information, certainly at least on here, is stuff that you would expect, right? It's information about the seller and EINs and that sort of thing. And then it starts to get deeper. It gets deeper about the type of credit. It gets deeper about the credit property. We get into the physical location, get into permitting, get into construction dates and place and service dates and all those sorts of things. And all of this has to be signed under penalty of perjury. So if you have an appetite to go a little bit deeper on this, I highly recommend the IRS publication 5884. And that gives you it's a really good guidebook on how to set up your ECO account, but also what is it going to look like? What should you expect as you're going through and doing the registration, not just for yourself as a seller, but also for the credits themselves. Once a seller gets a registration number with respect to a credit, it's important to know that that's not an endorsement that the credit itself is valid. All that means is that the credit let's say it's passed the registration process with the IRS. You've provided enough information. So the IRS isn't saying, hey, buyer, you got a registration number, it's a valid credit. It's just saying, hey, buyer, the seller got as far as registering the credit and getting a registration number that facilitates that transfer between you and between you buyer and you seller. Also, I think really interesting to note in the IRS guidance about this is their direct involvement in helping facilitate obtaining registration numbers for sellers. So the guidance that's provided is that the seller should budget somewhere between 90 and 120 days to get a registration number from start to finish. But there's guidance in there which I thought was really interesting that says that if you're reaching a certain deadline and that deadline is you're under 60 days from the extended due date of the seller return and you don't have a registration number, rather than just like kind of an IRS, like a general information number, there's dedicated contact information specifically with respect to this item. So there's a dedicated email address and a dedicated phone number that sellers can use to gather to track down a registration number if they haven't gotten one yet. All right, let's take a minute on buyer compliance. On buyer compliance, it's a bit easier. Got to include that transfer election statement, which we haven't hit yet, but we're going to hit shortly. But you also have to include your 3800 with the tax registration number. And then I've got that note in there about credit carrybacks and carry forwards. And I think this one is pretty important from a buyer perspective to keep in mind. So if I'm a buyer in the marketplace and I need $4 million of credits, I may lightning may strike and I may find a seller who's got $4 million of credits, right? That completely meet all of the requirements that I've set out for myself as a buyer. But the reality is that may not happen, right? It may be that I'm in the market for four. I find a great seller, checks all the boxes, but they're transferring 5 of credits. So rather than giving up that deal, what I might do as a buyer is buy the 5 and then file my return claiming that credit, and then immediately apply for a carryback of those credits, right? And once you do apply for a carryback, those refunds tend to process pretty quickly. So I think you're looking at probably something like 60 days from the date of filing of your carryback claim to actually getting the refund in hand. All right, so this one is, we talked about seller compliance, we talked about buyer compliance. This is really compliance for both parties. That's the transfer election statement. This is a really interesting dynamic of how the IRS is thinking about how to report this, right? And kind of really truly marrying up the two parties once they've agreed on a deal to transfer these credits, right? So this transfer election statement is going to be an identical statement that both parties sign. It gets filed with seller's tax return. It gets filed with buyer's tax return. That's pretty interesting, right? It's the seller on this who signs the transfer election statement under penalty of perjury. Just the seller, not the buyer. The information that's included, again, it's, we're going to flip to the next slide, and we get a bit deeper, but for the most part, at least as a starting point, it's stuff that you would expect. Identifying info, EINs, describe the credits, tax years, how much did you pay, when were the payments made? We want to make sure it was fully paid by the date of filing the returns, the registration number that the IRS has provided, the statement of non-relation of the parties, very important because you can't transfer credits to a related party. But here's where it gets interesting, right? And here's where our theme of shifting of this burden of diligence comes back again. The buyer at this point, as part of their signature, they are being notified and acknowledging that there is a potential of recapture with respect to the credits, right? It's if there's an investment tax credit, right, that's subject to those recapture rules. The buyer has to acknowledge that and sign that they acknowledge it. The seller here has to represent that they're providing a required amount of minimum documentation to the buyer. That minimum documentation, super interesting, right? It's information that allows the buyer to validate the existence of the credit property. And here, the regs get into this validation can come from a third party. And as we get deeper and look at the recapture requirements, and the issues if there's an error in the credits, and the penalties that are associated with that, this importance of third-party diligence comes in, full stop, right? It becomes super important to avoid those penalties down the road. So for investment tax credits, we're looking for things like cost seg, or we're looking for reports from an insurance provider who is actually going to insure the credits, that sort of thing. We're looking in the situation of a production tax credits, we might be looking at it like a power purchase agreement, an offtake agreement, or something like that. Documentation perhaps from a utility that's agreed to accept the power once it's generated. So far in the transaction process, we talked about the first two, talked about the last three, and those four bullets in the middle of the transaction process. This is how you get your sale, right? How do you get your sale, and what do you do once you get there, right? Once you find a deal, how do you get yourself through it? So how do I find a deal, and what do I do once I get there, right? And I think this is where, the importance of brokers and advisors actually come to the table, right? I would say folks who are not typically in the clean energy space, how do you connect? Like how do you find projects that are of the right that are correct for you as a buyer? So I'll tell you where I always start is size, right? So, if you think about the premise that most sellers want to sell the whole thing and sell it all at once and close right away, and buyers only want to buy what they need and take their time to pay for it. The reality is, the sizing of the project really has to be the first thing that you match. So, like if I'm looking for $4 or $5 million, I can't go to a guy, a seller who's selling 50 and ask them to break it up into pieces. Chances are I'm not going to get very far with that. Um, Pricing, obviously, that's a huge part of the process of figuring out whether you've got the right deal. Um, the type of credit. Some buyers have a lower appetite for risk and only want to look at production tax credits, even though they're going to pay more than they otherwise would for an investment tax credit. Timing is important, and that's timing of when the project is going online could be important. Timing could be important in terms of when does the seller want to close. Timing could be important in terms of when do the parties agree that payment should be made for the credits, right? Tax year compatibility could be really important. Like if you're a fiscal year buyer and your fiscal year ends September, October, November, um, and you're trying to work with calendar year sellers, that's an added challenge, right? So in certain cases, what we see is that where there's a gross mismatch, the best opportunity for those folks is to try and find a tax equity deal as opposed to a transferable tax credit deal, because the tax equity deals you have flexibility in terms of how you set up the fiscal year of the project itself. Willingness to insure. Um, that could be very important. A lot of the deals are insured, right? And that means there's insurance in case the credit's wrong. There's insurance in case the basis that's used to calculate the investment tax credit is incorrect. There's insurance in case there's a recapture event. Um, is a seller willing to insure a project? That could be a big factor for a lot of buyers, particularly in this space where we're looking at credits that are sub $10 million. Insurance is very important. Not just the willingness to insure, but the coverage of the insurance can be important too. So if I think about this from the perspective of a buyer, if things go sideways, and there's a recapture event, which means the credits I paid for are not valid, it's not just the credits that I'm on the hook for, all right? I potentially have an underpayment of tax penalty. I may have advisor fees and that sort of thing. So in a lot of cases, we see that the insurance coverage isn't just for the credit amount. It covers something like 120% of the credit amount to cover all of these things. I think, and hopefully what you're seeing as we kind of talk through all of this stuff is that, there's an intangible here too, right? As a buyer, you want to find a project where the seller is kind of going to go through this with you, right? And is easy to work with and is responsive and, is going to be helpful if things go sideways, right? If you have somebody who's difficult to deal with all the way along through like negotiating the term sheet, chances are they're going to be really difficult once the deal docs are signed and they've been paid, right? So that's an intangible that I think is pretty important. And I think that's where the brokers and advisors really add a fair amount of value, right? Is to kind of do some of the screening and some of the vetting on this stuff so that as a buyer, you're really only looking at stuff that is going to work for the long term, right? So once you kind of agree on all of these factors, right, of pricing and timing and all of these things kind of come into place, you sign a term sheet with between buyer and seller. It's typically non-binding, with the exception of like confidentiality terms and those sorts of things. And then that once you're at the point where you have a term sheet in place, you move on to diligence, right? Diligence really critical, right? Um, from it, from a diligence perspective, I've got those like non-clean energy vehicles there. Those are non-clean energy intentionally. Those are dirt diggers, right? They are looking for problems. They are digging as deep as they can to find out if there's issues. So from a diligence perspective, what are the things you want to think about? Seller eligibility, right? Does the seller own the property? Are they entitled to claim that credit themselves, which gives them the right to sell that credit in the marketplace? Have they done anything that potentially limits their ability to transfer that credit? Have they assigned the credit to someone else or those sorts of things, right? Um, the qualification of the property, right? We're qualifying the credit. So here we're looking at placed in service, right? Can we verify that the property was placed in service? Can we verify what was spent to acquire the investment tax credit property? There we're looking at cost seg reports. We are looking at on the production side, we look at those offtake agreements, we look at power purchase agreements. We want to make sure that those are in place and operational, and there's nothing that hinders it, right? If there's a bonus credit involved, we get into looking at we look at wage reports, we look at timesheets, we look at qualification for content. Sometimes there are domestic content bonuses. We look at locations for energy community bonuses and those sorts of things. But really, the heart of the diligence, I think, is really on these last two, right? We're looking at recapture risks. We're looking at if something goes wrong, how good is the insurance, and how good is the ability of the seller to make good if things go sideways, right? So certain deals are either partially insured or not insured at all. In those cases, you're looking at a seller guarantee, or they may have an indemnification requirement. They may have a parent guarantee, and those sorts of things. We really start digging deep on that stuff. On the recapture side, you're looking at the location of the property. You're looking at the history of the developer, right? Um, is this their first rodeo? Have they done this before? Do they know what to do when things go wrong, right? All of those things super, super important. You're like stress testing the balance sheet of the seller and perhaps the parent of the seller. It's the parent of the seller who's offering the guarantee on the credits. And from our perspective, like kind of operating in this market that's sub $10 million, we get lots of calls for like kind of smallish credits, like even sub $500,000. And really, the issue with those is it's really hard to diligence those effectively, right? It's just not cost effective to do that. So that discounting on those credits becomes really steep. So you can build in enough budget to cover the diligence and documentation costs around those credits, and then it just becomes unfeasible. You get sellers who say, "Look, if I'm, at 60 cents in the dollar, I may as well just keep the credit and I'll use it eventually," right? So simultaneously, while we're doing diligence, is we're working on documents, right? Um, uh, on the documentation side, super important, right? We're looking at how do we resolve disputes. We're looking at what happens if there is an indemnification requirement. We're looking at notice requirements, compliance issues. Um, we are really putting guardrails around how do those guarantees work, timing, timing of payments. But really, at the end of the day, what this comes down to is like reps and warranties and the strength of the identification, strength of the guarantee, strength of the insurance, right? That's truly what we're trying to paper ourselves around. Um, I think one of the things that's in here, there's a forbearance agreement, a note in here about that. In certain cases, some of the projects are debt financed. And in those situations where you have a debt financed property, The buyer will want a forbearance agreement from the lender, allowing them to ensure that they get some sort of preference in terms of payout if there's an event. All right, so we talked a lot over the last couple slides about recapture and what happens if things go sideways, right? It's we're into the risk section of the presentation, right? Pre-transfer risks, they kind of largely fall to the seller, right? The buyer, as long as they haven't paid for the credits, aren't so much on the hook for the pre-transfer stuff. On the post-transfer side, it's a bit of a split, right? It's buyer and seller who may have issues there. I think on the pre-transfer side, I think one of the things that kind of kicks in from a seller perspective is, we're today is January 13th of 2025. We see sellers in market now for 2025 credits, right? For stuff that hasn't even been built yet. So they're looking for buyers for projects that aren't complete. So I think from a seller perspective, there's a bit of you're doing a bit of a tap dance, right? You're trying to ensure that project goes online. You're trying to close a deal with respect to that project, assuming it goes online. There's a bit of there's multiple plates in the air, right? There's multiple spinning plates to keep an eye on. Um, on the buyer side, the issues that you have to worry about are recapture and financial issues of the seller and those sorts of things, compliance failures. You have to worry about, is there an event that triggers an issue? Did the seller get it right? I mean, did they compute the right amount of credits and those sorts of things? And we'll talk about all those a little bit on the next couple of slides. But also, I think on the buyer side, you worry about like fear of missing out. Like, is there a better deal to come along? Um, the reality is it's not like shopping at a supermarket, right? There's not like you don't necessarily have your pick of dozens of credit projects, right? Sometimes if you're looking for something pretty specific, and it comes along and it may not be exactly what you wanted to pay, or it may not be exactly where you would like it to be, that project, you may have to make some concessions to get a deal done. All right, so this is the one that I think most buyers worry about, right? What happens if the reported credit amount is incorrect? So if the seller sells a credit and it turns out that the credit was more than what the seller sold, um, it's from a buyer perspective, you're kind of done. You bought what you bought. Your credit amount doesn't change. That additional credit amount becomes an asset of the seller, which is not such a big deal, except from a seller perspective, you may have already had credits that you couldn't monetize. So now you may just be stuck with a credit that's tough to monetize, tough to use, right? And because of the timing of when the credits have to transfer, chances are as a seller, you're going to be stuck with that credit perhaps for quite a long time, right? I think the thing, and here we go, here's the heart of it, right? What happens if the credit amount turns out to be less than what you bought, right? So, on an amended return or an audit, it turns out that the seller sold more credits than what they were entitled to sell. So, um, the way the rules are designed, they're designed to protect the buyer as far as they can. So, let's say a seller thinks that they've got 10 of credits that they're able to sell. They want to keep 2 for themselves and sell 8. And it turns out they only had 8 available. So the buyer bought 8. There's only 8 available. It's the seller who bears the impact of that, right? They're the ones who have the adjustment to their tax return. All right, let's try a fact pattern where the seller thinks they have 10 and still the same thing, want to keep 2 and sell 8. They do that, but it turns out that the actual credit amount that was available was only 7. In that case, the seller loses there too, obviously. But here's where it kicks in for the buyer, right? The buyer's going to lose that 1 and have an adjustment to their tax return. And here's where I think, this is really where it all comes to a head, right? Of this idea of shifting the burden. We come back to this theme again of shifting the burden of the parties. Here's where it really shifts to the buyer, right? In that situation that I described, where there was 1 of excess credit that was transferred, the buyer is subject to a 20% penalty on that credit amount unless they can show reasonable cause. And the reasonable cause is truly at its heart, it is a failure to diligence penalty, right? That is how to think about it. So this is where it is so important to do the diligence, but also I think this is where the third parties come in, because the regs actually talk to one of the favorable factors for avoiding this penalty is the buyer's reliance on third parties in determining the eligibility and validity of that credit. So if ever it was, if it wasn't apparent before, it should be really apparent now. Um, the shift in burden, A, and B, the super importance of diligence and documentation. All right, recapture is a bit of a different scenario, right? Recapture kicks in for investment tax credits. So if you think about the way an investment tax credit works, a seller has a seller has purchased qualifying property, generated investment tax credit, and decided to sell the credit. The seller has to retain that property. So again, back to the documentation, one of the things, the reps and warranties and covenants that the seller has to enter into is that they're not going to dispose of that property. If the seller disposes of the property, or the property otherwise ceases to be qualifying property, over a 5-year period, there becomes a recapture event, and that recapture event affects the buyer. So the recapture, the way to think about the property ceasing to be in effect is if you have a community solar development and a tornado comes through and wipes out that development, and with it all of those solar properties, or you have a ground installation of solar and a tornado comes through and takes that solar out. That property ceases to be eligible property, and you have a recapture event. Recapture period is 5 years. It's a stepped recapture, meaning every completed year, 20% comes off the table. So at the start of year 6, after the property is placed in service, the recapture risk goes away. The way to mitigate this from a buyer's perspective, A is insurance and B is contractual. All right, state of the market. So there should be, we think there's going to be about $25 billion is where the number's going to settle for credits that were transferred during 2024. Pretty good. We're seeing that the market is slightly stronger for sellers than for buyers, meaning at this point in time, I can tell you from my own practice, I've got buyers who are looking for credits and have not been able to find credits with respect to 2024 that work, right? So the sellers are commanding a bit more on the pricing side. Solar and wind tend to be about 67% of the market, 70% of the deals are insured. Pricing, investment tax credit, average pricing 92, production tax credit about 95. Thing to keep in mind here is these are really averages across the market, right? I like to describe this as the tale of like two Ford F-150s. If I buy one for 20 grand and Amit buys one for 30 grand, how could that be? They're both, 2019 F-150s. The reason is mine has 100,000 miles, his has 30,000 miles. His was better cared for. His has never been in an accident, right? It's kind of the same thing with credits, right? All of these things factor in. What's the size of the deal? Smaller deals tend to price a bit lower. How insurable is the deal, right? What's the strength of the developer and their history? What's the type of technology? Some technologies that are more, quote unquote, established, will command better prices than stuff that's brand new, right? Um, what's the time of year? Is the seller getting desperate to sell credits, or are we where we are today in a buyer's market? So I think another thing to kind of keep in mind here, when I say the market is slightly stronger for sellers than buyers, as a buyer, one of the things that you want to think about if you're interested in pursuing this is making yourself the best buyer you can be, because it's not always just about price, right? If you think about sometimes people buy and sell houses, a seller may get multiple offers on a house and take one that's a little bit less because a buyer is willing to close immediately. They're willing to forego an inspection. They're willing to forego a mortgage contingency. It's the same sort of thing here, right? You got sellers who have credits, they want to monetize them, they're looking for certainty. They may take, a half a cent less per credit, in an effort to get that close done as quickly as possible. Yeah, so a couple things here. We see it's not always, but often, sellers do cover some of these costs, if not all. They'll cover some portion of buyer's legal. In many cases, they may cover part of the due diligence costs associated with that. Insurance is almost always covered by the seller as opposed to the buyer. It's really the seller who has to procure that policy. They're the ones who can provide the documentation that it takes to actually get that done. I think, from our perspective, we try and set this up as like from a buyer perspective, as hassle-free as possible, right? So from our perspective, we are looking for actively in the market for sellers who will do these things and make it so that, look, we've got a standardized set of documents. They are not, overly friendly to one party or the other. They're a fair set of documents, and we can like agree on a price and kind of like that's it. The deal is complete. Yeah, so on the investment tax credit that we see, it tends to be 85 on the low, 92 on the high. Um, Production tax credits, we see some of those, but to be honest, most of the stuff that we see in our day to day is more on the investment tax credit side than the production tax credit side. Our first iteration of this presentation was about a month ago, and about a month ago didn't have a whole lot of information, and still don't have a ton of information, right? We have some, but not a lot. And honestly, some of the stuff that we have is inferential as opposed to definitive, right? So I don't know, but many of you, I'm sure, saw that President-elect Trump held a news conference maybe about a week ago that covered a really broad range of things. And this was the same news conference that covered the stuff about acquiring Greenland and renaming the Gulf of Mexico, but also included in that press conference, he made a reference to wind energy and said that he was set on making sure that there were no new wind projects that came online during his administration, right? And the quote that he had was wind turbines are bad for the environment and dangerous for whales. So you kind of see at least a direction, right, on something like that. And then a couple of days ago, like maybe like 2 or 3 days ago, there was some guidance that came out from some of the advisors in the marketplace, and they were kind of focused on some of the Trump administration or incoming Trump administration's kind of day one promise to halt any new regulations, right, from taking effect. So anything that had been kind of like decided but not made effective yet was going to halt. And there are some regulations applicable to some of the new credits, right? That may kick in. So the thought was, hey, the administration seems like they're certainly not friendly to wind energy and certainly not friendly to EV energy, right? So those charging stations and that sort of thing. So the thought was, hey, maybe what will happen is this will be chopped up piecemeal, right? And some credits will remain transferable, and some will get knocked out, right? Like the wind stuff, the stuff that's related to wind. So it's still a little tough to say, right? We still don't really have a great kind of telescope to see what the future looks like on this. Um, but I would say, one thing that I think is, has to play into this is that um, the impact of the IRA was it really truly did open up the market for a lot of developers who otherwise would not have been able to capitalize some of the work that was done. So it really did have an impact on job creation and production and construction jobs and that sort of thing. So there is a real impact. So I often wonder whether, as you sit down, and not when I say you, I mean the incoming administration sits down and kind of looks through some of this stuff in a bit more detail. Where will they land, right? Will they be able to find a way to kind of keep some of these things in place, or all of them? Investment tax credits tend to command more favorable market prices than production tax credits. We deal with a lot more buyers, so more favorables in the eye of the beholder. In this case, from a buyer's perspective, that is true. Investment tax credits tend to be cheaper than production tax credits.
And just one question that came in on the info, we'll finish up with that, what is the typical time requirement for a buyer for a production tax credit of $2 to $3 million?
It's a good
Probably depend a
question.
lot on how much they're
Yes. It
using
depends
outside
on,
advisors and
yeah. So the closer
doing a
the deal,
hassle-free deal that you talked about
yeah, a
versus trying to
hassle-free
insource.
deal. Yeah, I mean, I think you're looking at like 4 weeks to 6 weeks at the outside. The hardest part of that timing wise is finding the deal. Honestly, once you find the deal and you get to term sheet, you can move that along pretty quickly. Those are pretty easy to diligence and pretty easy to paper in terms of the documents. So the production tax credits are pretty easy to get done. The hardest part is finding a deal that works.
And I know we're over one last question. I think I can even answer this one. Could my client file a conservative individual return early just to generate the credit and then amend later? Seems
Yes,
like a fairly common practice.
it is. Yep, for sure.
Yep.
Yep, we
Okay.
see that quite a bit.
And then that would also enable you to start your carryback process right away
Exactly.
as well.
That's exactly it. Yep.
Okay. Great. Well, thank you very much. Appreciate everyone's time. Mike, thank you so much. I know we went a couple minutes over, but again to our sponsor, Sachs Consulting and Investigative Services. So appreciate everyone's time today and thank you very much.
Thanks, Amit.
Thank you